Welcome, everyone. My name is David Murphy. I'm the founder and CEO of TechFire. It is an honor to have you joining us today, and we're so grateful to have an incredible speaker with us, Aydin Senkut, and amazing moderator, Michael Platner. I just want to give a shout out before we go any further to Louis Brisbois for sponsoring today's event, presenting sponsor. They are one of the top law firms on AmLaw 100 list with locations all across the U.S. And expertise across more than 40 specialties and multitude of subspecialties. Michael is himself one of the key leaders of the firm. We're very honored to have you in the moderator seat, Michael. He comes from the entrepreneurial world himself, as well as angel investing himself, but these days is more than busy in his role as many roles as chair of the corporate practice and co-chair of the securities and corporate finance practice and managing partner of an office for the firm. So very busy guy. Thank you for clearing your schedule to do this. Really, really grateful. A lot of, lawyers we work with to moderate, I have to prep a lot, send a lot of questions over. Michael's someone you'd find, if you're a founder looking for, a lawyer to help you, someone who's already been in those shoes, so he already knows, all the right questions in this case to ask. So I'll get out of the way shortly, but he's also someone who can help, guide you, having been in those shoes as an entrepreneur, if you're looking for legal representation for your company. I just want to say I've seen, personally actually, but also others too, what happens when you're a founder and you, maybe try to go with your uncle's, divorce attorney or, some random attorney to do your incorporation documents, and, everything can come crashing down. So it's so important to get things on a firm foundation when you're starting. And then, of course, when you're looking to, do deals, Michael's a deal maker, in particular, looking to build your company to have the right legal partner too. So if you are looking for, the right legal partner, you'll find one right here. I'll just say that and won't say any more, but thank you indeed to the firm, and thank you to Marty, Jennifer, Daniel, Sydney, everyone who's worked behind the scenes, and just Michael too. So in terms of thanks, I also want to give a shout out to Sue, Aydin's wonderful new hire at the firm there. Just been wonderful to work with in her comms and narrative capacity. So thank you very much, and the whole team there too, of course. So without any further ado, we all know, of course, for those of us who read the Forbes Midas List of top VCs, or the New York Times top 20 list of top VCs, we've seen Aydin on there just about more than anyone else. But I'll give you his quick bio. He came originally many years ago as one of the earliest leaders at Google. He had been the senior manager responsible for actually being its first product manager, launching Google's first 10 international sites, international sales manager at Google, the first person in that role, and, was able to jump out and become one of the original super angels eventually, and now doing multiple, stage investing, of course, many years later here with the firm. And, the deals speak for themselves, right? Companies, the portfolio companies like Shopify, Fitbit, Rovio, Credit Karma, SoundHound. I mean, maybe one of yours, those in the audience here too, can be one of those featured logos on the company someday. You never know. But when I see someone who's been on the list, the Forbes Midas List, that many years in a row, I want to know what the secret sauce is. So I'm going to turn things over to Michael here to maybe ask that question without any further ado, and we'll all give a virtual round of applause here, thanking you for joining us, Aydin, and thank you, Aydin. Thank you, Michael, as well. So without any further ado, go for it.
Thanks, David. Can you hear me okay? Can you hear me?
Good.
Good. Okay, great. And nice to see you, Aydin. It's great to have you. And I hope all my questions will be good questions. And of course, the first question, which was with David's lead-in, was really how do you get listed not only in Forbes, but New York Times and so many other places as being one of the most successful VCs in the world. Is there a secret? What is the secret to your success?
Well, first of all, I feel humbled, and thank you, David, for having me, and thank you, Michael, for this great fireside chat. I mean, I feel extremely fortunate because I do something that I truly love. And then when you make it onto some of these lists, obviously it's a great outcome. I'm not in the evaluation committees of either Forbes or New York Times. I will just be grateful to be included in those lists. But in terms of, I'm not really sure there is a secret. I do think that obviously luck always plays a role. And in addition to luck, strategy plays probably an equally important role. And the thing that helped us a lot, I think, is to be thematic investors. I think we have done a good job of being forward looking and at the right time, think of markets and companies that will be successful in the future. Not backward looking necessarily and see something that has worked, but instead looking into the future and thinking, how will the world change and what companies and markets will play a critical role? So we're very happy about that. I think the second thing is an interesting part of our firm strategy. I'd like to say, hey, like if you're playing football or, I like playing tennis, it's kind of like, playing into the doubles line in tennis or in football, having the goalpost twice as wide and twice as high, where our firm strategy is differed from many other VCs that like to specialize and keep the investment focus very narrow. That is great in terms of, facilitating diligence. But for us, one of the factors has been we've gone the complete other direction where, our investments range a lot of different geographies. David mentioned Shopify in Canada, Rovio in Finland, Adyen, which is a Dutch company, which is probably our largest exit to date. We have some companies in Australia. We have invested in about 9 completely different sectors across stages. And these sectors, by the way, include not just consumer and enterprise companies, but also biotech and frontier companies. And it's not an easy thing to do, but I feel that that really has helped us in terms of the number of successful companies we had, whether it be private valuations over $1 billion or IPOs and mergers and acquisitions, probably has been one of the biggest factors that, we instead went the other direction from typical VC. And instead of narrowing down and focusing more intently, we took a broader approach that tech is impacting pretty much every sector in the world and not just in the US, and find the world's best companies and sectors we feel are going to be important in the future.
Having such a diversified portfolio, can you characterize a sweet spot for Felicis?
It's so different. I mean, we have companies where we have written the first check on the back of a napkin. We have other companies that have been much further ahead. I think the thing that we like, the factors that really help us, number one, we like to work with missionary founders that truly are on a mission and truly care about what they're building and why they're building. We like to work with founders that are extremely articulate about how they're going to achieve success at scale. Then the next element that we really care about is that the companies are solving a critical problem that is easy to understand. I mean, in some ways, when you look at Shopify and you tell somebody, hey, we're building the next commerce platform that's going to combine both online and offline experiences. Obviously, commerce is at the heart of like pretty much every business around the world. Or, Rovio was for the longest time one of the top mobile games and mobile applications in the world across all countries. Or Adyen is the world's most sophisticated payment solution, and the only one that I think works in 190 countries. So like when you explain simple things like in a simple sentence like that, or we had other companies totally different that basically managed to, for instance, like impact the area of cancer, where instead of doing a biopsy, they can detect cancer through a blood test. Like again, just a simple thing, but the one thing that you'll notice in all these companies, number one, it affects either a broad group of people or companies. And then the second thing is critical. So there are a lot of technologies that are awesome when you hear about it, but they might not necessarily be solving a problem that's critical or what we like to say timeless. So those, having that approach has really helped us find great companies.
So would we get a glimpse into that strategy? I know you recently welcomed Stream into your portfolio. Talk about that one.
Absolutely. That's another interesting company. It's actually based in Colorado, but most of engineering is in Holland. We're seeing it more and more where companies are located in multiple places and not just a single location. And one of the reasons we got excited about Stream, especially in the last year or two, we noticed that one of the most fertile areas for investment is going to be in the areas of infrastructure, DevOps, developer operations, companies that are helping developers as they're increasing very, very high in number, as well as security. You've noticed and heard a lot of news stories about hacks that is going on even at the nation state level. So one of the reasons why we're really excited about these areas, the way that companies work fundamentally is changing. When I went to grad school and I studied economics, it was like, hey, you have people, you have labor, and you have raw materials. Now you have people, and then you use Amazon Web Services or Google Cloud or Microsoft, and there's not much else. You don't really use raw materials anymore. So the way that we think of a company has drastically changed. And so that's the reason why we're excited about these areas. And within that, Stream plays an important role, especially post-COVID. They allow companies to have chat functionality. It has become more important than ever. Maybe not my generation, but pretty much everybody now expects an immediate response, and all the companies have to build a robust chat functionality. People don't want to be like waiting on the phone line for hours or so as this functionality becomes really important, companies realize that to be able to have this reliable and scalable is not an easy thing to do, and they don't want to necessarily burden their engineering teams to build this functionality from scratch. Stream comes into this, and they have built an infinitely scalable platform that is based on the most important technologies that all the developers use, and have made it really, really easy for companies to build this chat and feed functionality into their solutions and mobile apps. And this is one of the hottest areas, anywhere from gaming to financial services to Fortune 500 companies. So we're seeing it adopted across a wide range of industries.
So let's take that portfolio company as an example of how your process works. How does a company become engaged with Felicis?
Actually, in this case, we have outbounded them and we have reached out to them, which is another thing that makes us a little bit different. While we obviously very much welcome any inbound opportunities to invest in companies and founders, we have also taken matters into our own hands. And whenever we got conviction in the market and what we felt like a company that is going to be a current or future leader in that market, we have also kind of reached out to them proactively. In this case, we discovered Stream right when they closed their Series A, and we kept on the company even though they just closed a new round and didn't need any money. Built a great relationship with them over a few months, helped them in various different areas, and they realized how much conviction we had and how many different areas we could be of help to them. And then it basically became a matter of, hey, if we want to be on the same side of the table, investment is just a way of making that happen. And we are very fortunate. And there was great demand also from existing investors. And it kind of came together very quickly at the end, towards the end of the year. And it just got announced. So we're very excited to partner with them.
So congratulations. And you're out building your own, let's call it a warm pipeline of these kinds of relationships. How does it happen if someone approaches you and it's completely cold? You've never heard of the company. There's no warm relationship. Is that a deal that's got a disadvantage coming to your doorstep?
I mean, look, I think in the COVID environment, given that we can't really meet people face to face, obviously it makes it a little bit more it feels a little bit more like unattached, like when you have that conversation only over a call or email or Zoom. There are two things that we do when we get an inbound investment opportunity. The first thing that we do is we make sure if this is in an area that we focus or care about. because if that's not the case, it's not even worth spending time on it. Then the second thing that we do is, even if it's called, we do have a broad network, either through our own team, which is quite diverse, or our founders, with 300 plus existing and exited investments, we have quite a large portfolio. And if you consider all the people that are part of those companies, we have a quite extensive network. And so we're always trying to see if there is some people that we might have in common. And that really also helps, because then at least we're not starting from absolute scratch. But there's been also many instances where we have no connection to the founders or the company whatsoever, but we just fall in love with what the founders are trying to do and their mission. And especially if it's an area that we really care about, then we roll up our sleeves and find out what we can do to help, as well as, if this is one of those companies that, we need to be in at all costs.
Are you geographically agnostic, or are you biased toward West Coast firms? Or it sounds like you do have European investments as well in the portfolio.
No, we are geographically agnostic. I think we have well over a dozen states in the US. We have Canada, we have, Western Europe, Australia. I mean, there are some places, we have an Israeli company, but I would say that we are right now not touching China or India. I feel those countries have their own ecosystem, and not having a local office or local team, we don't think that we can be as effective in some of those geographies. And then there are other geographies we just simply don't understand really well, or it's very locally focused. So one of the things that we look at, often a little bit misunderstood about our strategy, the fact that we invest in companies outside of the United States, the primary factor that's driving us is to find companies that can be global leaders. We are not looking for, oh, here's a big company in the US, here's a copycat in a local market, and they can be great in a local market. That's not what we're interested in. We're interested in global leaders, but agnostic about where the company is headquartered in. Again, some of the examples we use, Shopify, they can come from a city, Ottawa, which is not known for its tech jobs, but the company has been great. Adyen is from Amsterdam. We don't see companies from Amsterdam every day. Our company Canva in Australia, from Sydney. These are global leaders in their field. So that's what we're really interested in. And, we are extremely agnostic in terms of where the company is based.
So speaking of global leaders in their field, obviously at the time you've made the investment, that's only a gleam in Aydin's eyes, so to speak, correct? In other words, you don't know for sure when you make an investment that you're going to suddenly have a portfolio company that's going to be able to say it's a global leader. Mm-hmm. So the question is, in looking for those types of investments and looking at how the pandemic has impacted your firm over the last year, did you learn anything different about how to approach that process and how to scrub those companies when you couldn't jump on airplanes and see people face to face?
Yeah, look, I think in some ways we have kind of gone in full speed. We basically just had to adapt. By the way, the number one core value for our firm is learning and adapting rapidly. So there was no option to pause or slow down or not to do what we do. We just had to adapt to the new normal. I think if anything, it amplified certain things that we do. You're making a really great point that, hey, these companies might end up being global leaders at some point, the lucky ones. But at the time that we invest, by far, that is not obvious. There is maybe some signs. So what we're really looking for is, this is what we care about, how the founders articulate their plans for success at scale. They might not be there yet, but there is a way that they describe what the future looks like, how they're going to get to success, what it will take. Especially important for us is the founders' ability to explain what their plan is, if they can break it down, how they deconstruct success, all the different variables, and how it's going to be measured in terms of how they're going to measure progress, how to get there. If all that happens, honestly, I think it's probably at least 50% of the journey, because you've kind of like drawn your route on a map. Now, will there be zigs and zags? Of course. Will there be unplanned things happening? Of course. But having a plan and having a plan of action, and figuring out how you're going to measure progress within that plan of action, is probably equally important before we get to that point where we can say this company is made. It's a clear global leader. That's what we care about. The second thing is I think we're spending more and more time on the founders themselves, their background, why they started the company, what in their background makes them extremely resilient. Why do they really care about this problem space, and what unique insight they had at the time they formed their companies that was not obvious to many others. So we also think of ourselves as kind of like intelligence agency. Like it's very important to be able to judge people, read people. You will hear a lot that venture business is becoming data oriented and people are optional. We think the opposite. We think people are the heart of all the companies. Like we are backing the founders, which are the founders are the company. We feel that the diverse team that we have is an important factor, because if you want to be able to understand and read people, having somebody in the team that might relate to them or understand where they come from or their experience or their background is really, really critical, which is one of the reasons why I think, having diversity in the team has been core to our success.
So obviously you have a pretty amazing crystal ball on this process of trying to understand whether founders are the right people that you want to invest in. Can you share with us any surprises that you've had in recent years where you learned something shocking that either ended up being a lot better than you thought it would be or a lot worse? And you don't have to give names necessarily, but the more color you can give, because I know for us and our clients, it's a lot of times the failures and the mistakes that you make that teach you the greatest lessons. What can you share with us about that?
Yeah, there are definitely a couple lessons. Look, I'm again humbled. I clearly don't have a crystal ball, but what I can tell you is that I have one job that is what we can control, and that is our strategy and portfolio construction. So the way that I think about it, as the founder and leader of this firm, is that everything that I do is geared towards one thing and one thing only, and that is slanting the odds in our favor. So if we can make it better than 50-50, like through our strategy, where we look for companies, look for sectors that are maybe not as popular or hot, whatever it is, before they become obvious, and through our own diligence process, whatever, if we can slant the odds and like, hey, 5% improvement here, 3% improvement there, 7% improvement, and these compound to a bigger difference, then, if we can do better than 50-50, obviously we're going to be successful. So that's what we try to engineer at all costs. In terms of the surprises, look, I think there's been a lot of surprises on the upside, to be honest with you. Like, I had the same experience at Google. Like, I was hoping that it was going to be a big company. If you ask me, will it be $1 trillion company? I would probably tell you the probability of that is pretty low. If you ask me, Shopify was going to be a great company, I thought, well, if we're lucky, maybe 10 billion. And now it's well north of 100 billion and still going. Same thing happened with Adyen. We knew that it was going to be an important company. It was very critical to companies like, Facebook, Microsoft, Uber, and Airbnb. And next thing you know, like they have a market cap of 60 billion. We've been in these companies at like way below these numbers. So I think the thing that I'm seeing is that when you're solving a critical problem that applies to every business in the world, or every person in the world, or everybody in critical need, like we were talking about cancer, if you do what you said that you were going to do, and you do have a unique insight, chances are it's probably going to be a big company, and chances are that it's probably going to be a bigger company than you expected. The surprises on the negative, honestly, we also see ourselves as a coach to founders. And the number one thing that I tell people, basically like two areas where they get surprised. One is they don't realize that it's a race against the clock, right? So right now, like we might discuss an investment and it's going to take 6 to 8 years. And it sounds like there is so much time. You can try a lot of things, wait on it for months, if not years. And if you ask me, most successful companies we have are doing things on a daily or weekly basis at the most. They're constantly doing things, seeing what the results are, iterating, adapting. They might have a strategy that doesn't change, but the tactical execution part has very fast moving parts. So I think the most successful founders not only have a great vision, but they understand it's a race against time, because that insight might no longer be unique in a few months' time. So the only thing that's going to be a key advantage for you is to move fast. I think the second thing is when critical decisions are made to try to focus on what we call objective signal and not personal bias. There is so much that is being asked, oh, like because we make good investments, we might be able to give advice and that advice should hold value. Or, somebody might say, we should do A because that sounds right. And what I always tell people is, look, we can make 100 great investment decisions and then the 101st decision that we come up with could be a complete disaster. We can be too full of ourselves and completely screw up. And so what I do every day, even like we had the best like run of great companies, we always go back and say, okay, even if it sounds obvious, did something change? Try to look at objective signals, try to gather data to make sure that for every decision, we have done our work. And so I ask companies, look, instead of worrying about it, instead of taking like, Michael, your opinion, or David, your opinion, just run a small experiment, see what works, what doesn't. See if you can get signals, see if you can talk to people that have been in this situation before and what they have done to make a better decision. That's what we try to do. We never give people like just plain advice. We try to get them more signal, more data, more background so that they can make the decision on their own, but do it so in a better way. So like, I would say that a lot of the negative surprises for companies is basically like, they just didn't take the extra time and work to figure out like what was the right way to do that decision, or they didn't consider all options, or they didn't like do the extra work to gather more data at the time. And you make one bad decision or one wrong decision, and then all of a sudden things start compounding. And where we also see this like actually happen a lot is in team building, right? Especially early on in a startup's tenure, you are a very small team and there's probably 100 things you need to do. And there is a lot of pressure to hire people. And what I see most often is founders get burned out. And there's like, look, let me just hire this. I just need an aspirin right now. I have this huge headache. We have this huge growth. We need to deal with it right now. I'm just like dying, just need to make this hire. And I think the most destructive thing you can do at a company is hire people that are below A+ or A. Just because you need to make a hire, because that kind of tends to compound. Like B people tend to hire like B and C people, but A people tend to hire A and A+. So, but what I mean by that is sometimes you got to be able to take short-term pain. And I felt it acutely myself. Like there's been many situations we could have easily added more people to our team, some of which look great on paper, but would have probably completely killed our culture or did not agree with our core values. And what is the point of having a culture and core values if you're not going to uphold them at all costs? It's kind of like the Constitution. If you're not going to follow the Constitution, there's no point in having laws. So, that's something that I found that is really, really important.
So that is really important. How do you usually fit in the investor stack for your portfolio companies? Are you the lead? Are you the first venture firm that they've ever talked to, or do you co-invest with other firms? What's your preferred sweet spot for where you fit in that process and size of investment generally?
So the answer is all of the above. And that's been also like a really important part of our strategy because, again, in an ideal world, not only do you want to make a great investment, you want to be the largest shareholder, you want to be the lead in that investment. And here's the thing, look, this job is already difficult as it is. I mean, in venture average, 1 out of 100 companies make it and become that, unicorn or the really valuable company. What we found is that if you're trying to optimize that investment decision across 6 different dimensions and say, not only do I need to find a great company, I need to get it at a bargain basement valuation. I need to own the highest percentage and all of that. It just doesn't add up. Like you can't optimize and have all these things. So what we basically have done as a firm is like said, look, when it comes, when push comes to shove, the only thing we care about is being in the right company. And this happens to us a lot. Right? Like sometimes we're a little bit late to the game. We can't lead. We can be co-lead. Sometimes it's only a strategic check. Sometimes it's like a token amount or whatever it is. And so what we said is like, the thing that is more important to us than anything else is to back the right founders and the right companies. If we need to make a compromise, we need to change the valuation. We need to have slightly smaller ownership, whatever it is, it's our job. We'll figure it out. Let's be in the company. Let's work with them. Let's help them. Over time, if we do a good job, there is probably going to be a chance for us to increase our ownership or whatever. And if the company is really great and we paid a high price, it's probably going to still look like a bargain. I don't think there's ever been a case, like, just to tell you, I share with my team, like half of our most successful companies have been probably the most expensive investments we've ever made, highest valuations. And at the time, if you asked me, I would have never guessed. Like, it was all borderline cases where it was uncomfortable. And those tend to always be the most likely positive outliers. And the big lesson from that is, outliers are outliers for a reason. If they all fit a neat mold, everybody would invest in all great companies, and we wouldn't even be having this conversation, right? So by default, it's not very easy to find the outliers. And by default, most likely it's going to be an uncomfortable investment. So we try to make it easier by being more flexible on some of the factors you outline, like, that's why we're agnostic on stage, agnostic on geo, agnostic on ownership and valuation as much as we can.
Well, and this valuation issue is such a hard issue for many of us, and I'd be interested to hear your view of it. I mean, how do you look at an early stage relative startup company and say this could be a world-class company, and we're going to put a valuation on this of multi-millions of dollars? They have no revenues. They've got a new team. We've kind of vetted them. What gives you comfort, or what guideposts to use in looking at valuation?
Yeah, so I think there is a couple key things to touch on here. I would like to be intellectually honest. Majority of our investments, there is some sign. We have made investments in companies that have no traction, but majority of them have something, like maybe at least a pilot customer of some sort, or some signal that something is working, that something about the idea is not just purely theoretical. But the way that I like to think about it is to be extremely crystal clear on the things that we control and the things that we don't control. When it comes to valuations, it is set by a market. We don't control the market. It's supply and demand. So whether they're high or low, we simply have no power over. The only thing that we have power over is to say yes or no to the number. And in that, actually, it's so simple. It basically comes down to your confidence in the ability of the firm or the startup to grow and execute their plan in the future. So the more articulate the founder is of their plan, and the more articulate the founder is, and it might not always be numbers, right? I don't really believe in like 3-5 year financials. Who knows what's going to happen in 3 to 5 years? But you can certainly have a very simple plan and saying, look, if things go well, here is what we think like is the portion of the market we can go after, or here is why the product is going to be great. So I think that really matters. And we basically like make a probabilistic assessment. So we are not saying, look, we have a crystal ball and we can tell if it's going to succeed or not. We basically look at, look, how many things can go wrong? How many things need to go right? How complex is this? And what is our confidence that things are more likely to go right than things are more likely to go wrong? And then we try to do a slide assessment, and we have obviously not just a base scenario, but a downside scenario. And that's it. Like, I think it's a lot of times binary, like either it's going to work, in which case we're all going to be happy, or it's not going to work. Like, there's no like other things that you need to factor or consider. So I think that has really helped us understanding the risk reward, right? So, if you're in a critical area, the market is really big, the company is some signal, it's easier to pay a high valuation than, hey, look, like we don't have conviction in this market, there's not enough signal. It just means that even if the valuation is mediocre, you can't just nail or dial risk reward. And in which case, like, it doesn't matter. So we try to like make it more objective. So then at least, we have a framework around if we're willing to pay this valuation or not.
So how do you feel about the founders? What advice would you give to founders in terms of voting structures, having come from Google? Would you invest in a company where the founders have 10x voting?
Well, we have kind of already voted with our action. So we are one of the few, if not the first VC to support founders unconditionally, at least by proxy, which is tell them that, hey, look, when we make an investment by proxy, we're going to vote our shares with you. It sounds a little bit crazy. I think what people don't understand is founders are the company and they're the soul of the company. When we're backing the founders, that's why it's very important for us to make sure we agree with their vision of the company 110%. because we're making this investment for them, and we truly believe in what their vision is. The second thing that we care about is doing that serves a very important purpose, more important than a board seat, more important than anything else, which is, do you have a trust relationship between the founders and the investors? Because I feel like if you have trust, you can talk about the difficult things. You can talk about things when things go sideways or things go bad. It's very important. Then you can actually try to fix them and try to make things better. However, if you are basically thinking that, hey, look, this is going to be like cracking the whip, we have a board seat, we have all this contract. The thing is, if you don't have trust, and if you're never going to see the truth, it's very difficult to have a healthy relationship with the founders. And I think it's going to be very difficult. Like, you might have a board seat and still have no idea what's really going on in the company. So that's why we feel that the more important thing than having a board seat or anything else is to have a relationship of trust and transparency. Because if you can talk about things at the right time, even when things go bad, even when things go sideways, single most important thing is to be able to talk about them exactly when it happened, because that's the time actually when you can fix things, you can react on things. But if you don't have the trust and confidence, then things kind of get stewed, and all of a sudden, like, you find out about things, you're like, wow, like 6 months have passed by. If we knew about it 6 months ago, we probably could have done something. Now your options are limited, your range is limited. It's much more difficult to do about things. The company might have lower cash runway. So that's why we feel trust is probably the most important ingredient in an investor-founder relationship.
But it sounds like you also do need that board seat. Otherwise, you won't have the ability to know whether in real time they're meeting those well-orchestrated benchmarks that you're using to mitigate your risk. Or have you made a lot of investments where you didn't have a board seat?
I mean, we don't necessarily have a board seat in every investment. Sometimes we have a board observer seat. I think what we want more than anything else for the board seat to also be like based on mutual interest and mutual desire that, hey, the founders really liked us and that's why they want us to be on the board. You're right. Obviously, it's important to know what's happening at the board level to kind of get transparency, especially for the larger checks. We try to do that. But the fact that we still really care about the trust part of the relationship, it's very important ingredient. It's not just, as long as we're on the board, it doesn't matter. For us, we'd rather have the trust. And, ideally, if we can also have some kind of a board exposure on top, we're happy to do that.
What would you tell a founder to anticipate is the check size? I know that there's a range, and you've made some investments for one reason and others as a more significant investment. But is there any general range you'd like to talk about that founders should look at?
Yeah, I mean, look, we've made investments now anywhere from like $1 million and slightly below to, I think the largest check we wrote was like a little north of 30 million. It's a wide range. Again, it's exactly like I mentioned. Maybe the middle of it is the sweet spot. Like I would say 5 to 15 is probably, where most of our investments like fall into. But the reason why we do that, again, it's not important. Like, we'd rather invest in the right company with the right founders, even if it's a slightly smaller check to begin with. That's what we like to optimize for. And to your, maybe this question, another question in terms of advice for founders. I mean, look, it is very tempting to see only the very best cases in the news and the best companies and best founders and say, well, if such and such company got this valuation or such and such company got away with X, I deserve that valuation. I deserve whatever it is. And I think, again, this is the thing about the market is supply and demand. Even though obviously, when all your eggs are in this basket as a founder, and look, I'm a small business founder myself, it's hard not to be emotional about it. But I learned that, hey, you just got to engineer success and you can't take it personal. I mean, now I look at some of our earlier funds and, hey, our LPs, like, they might have gotten a sweetheart deal, but they also put us in business. I'm grateful for that. If it weren't for their support, when we had like no successes, no IPOs, I wouldn't be here talking to you today. So just understanding to play the long game, to not try to optimize for every single thing, to not have that kind of jealous eye of, like if this founder gets it, I have to get it or I'm a failure. You have to completely forget about it and just play your own game and maximize things for the long term if you can.
Speaking of the long term, though, this is a pretty unique moment. in our economy and in our world, with the pandemic hopefully coming to its later innings? And how do you feel that this current economic, health, and political climate is impacting the way you're looking at the prospects for 2021?
I mean, there are a couple of things that I'm looking for. Look, I'm not even going to predict like, oh, when will we come back to post-COVID normal? Things might also not change that much. I think you're going to see a lot more people working remotely, even after, most people get vaccinated. So the way that I think about it is technology, it's so simple. Like technology has become a much larger part of life. I don't think that's going to change. Like how soon we get to the office, how many people spend how much time in office might change. But the fact that we're using more technology in life than ever before, I don't think it's going to change. So the way that I think about it is, look, as long as we find the companies that are using technology for good and making a great impact, if we basically make the right risk reward and we have as many of those as possible, like I have a very simple philosophy, right? So if you're only investing in a narrow sector, and that sector is wrong, you're done. Like you might be thinking, but if you're investing in multiple sectors, your odds of like finding the right company is probably much higher, because not all of those sectors will be bad. Some of them will be good. And then, with respect to just kind of overall thinking, like I said, I think technology is really important. I think being in it is very important. I think we're also seeing like just around the world, like companies that are leveraging technology to its best are being more successful, growing faster, and then others are not. So people are also, I mean, you're seeing it on the investment scene as well. I mean, in the last 10 years, one of the only like big bets in the stock market has been, if you invested in the right technology companies, they kind of like really appreciated in value. And especially in a very low interest rate environment or, zero rate environment, that is one of the best things you can do. I mean, money is still losing its value. The one thing I will tell you is like official inflation figures are one, but if you look at cost of a home or other things, like things have at least doubled, maybe tripled from 10, 15 years ago. So it's very important to find things like companies that are doing like the important things. And the last thing I will say is what I hope is that, look, I feel like I have the highest respect for founders and small business owners. Probably the most important thing we can do as a nation and as a government is to make their life easy. We need to take care of our small business. They're the highest, they're our biggest employers. I feel like rather than the government trying to fix the problems by itself or trying to do things that maybe help the big companies, not the small business owners, what we have to do at all costs is support our small business owners at all costs. I hope we can do that.
Well, I liked your comment about supporting the small business owners in building the team, and that this is a lot about people. Do you encourage your portfolio companies to use personality testing to construct teams?
So I think it's something that we recommend, and it's something that we try to help them at all costs. We also have this really great 1% pledge where we know how stressful it is to build a business. So we basically say, look, you know what? One of the best ways we can help you when things get really stressful, you're trying to build a team and you need coaching, we'll pay for it out of our pocket, up to 1% of the first check that we write. I think it's been a really, really game changing. To be honest with you, we have a very diverse team, and we had to do a lot of that ourselves, whether it be personality testing and other frameworks that we used have made a huge impact. Because I like to think that it's very difficult. Like one of the first things that I noticed as a small business owner and founder, there is no manual that tells you how to deal with people. If you ask me what has been my biggest surprise and what is the toughest thing about investment, you probably all think that, like making investments is really hard. Honestly, like if you have a strategy and you execute, it's been like, that part has not been that difficult. The part that's been like surprising is how tough it is to hire people, to keep them motivated, to manage them well, to do them justice. It's tough. People are not predictable. They're organic. Like they don't follow formulas. They can be emotional. I can be emotional. And I wish there would be a manual that said like, look, if you do ABC, everything will be great with your team. Everybody will be happy and successful. There's always some complication, always some drama. So what I found is that the more you ask for help, the more of like personality tests or frameworks you use, it's going to pay dividends, because at the end of the day, it doesn't matter what our potential is, what all of the founders out there, what their potential is. It's going to be strongly dependent on who they hire and how they can bring the maximum performance out of those people. I mean, even if you look at professional sports, just because a team has the most amazing players doesn't mean they're going to win the championship. You know, like normally the teams that win are the ones that are most high performance and the most unified as a team. They all act as a team. That's the part that's really important to get right, more than the ingredients is, can you like nail that team aspect? And I think you touched on something really important is it's really important to see how you can handle people and do them justice.
So that's a big question in light of your prior comment, which we're all observing. And I know I have many clients that are confused about the issue of, now that we've been taught that everybody can operate remotely, is that a great thing? And how are you advising your portfolio companies on the use of this newfound strength in remote operations, that people don't necessarily need to come together in the same building or the same place?
I mean, look, I think I have two observations, including our own, right? Just like everything else, I feel like it's a little bit of a tool. Used in the right way has great advantages, right? For instance, like even in the Bay Area where we are, the costs are just like dramatic. Like there are many people that literally have to give up their jobs and move because they, even with a great salary, they can't afford to live here, or they can't afford to live comfortably. And I mean, it's kind of crazy to say this. We're in one of the world's best places. And, you know, we'd like to think that there are like great like comps for people. And this is a very expensive area to live in. So in some ways, like giving people the freedom of they can be their best wherever they are, it's a very liberating factor. But then there's a cost. And the cost is simply, you know, this kind of gathering people over Zoom and like, look, here we are over Zoom. You just don't have the same energy as if you were in a room and you can see people, you can feel their energy, you can look in their eyes and you can see like how they're feeling, or if they're paying attention, if they're energized, they're not energized. It's just very difficult to do that online. And one of the things that I'm realizing is that we probably have the highest like mental health issues, angst, maybe like levels of depression that we've ever seen. I don't know if people will be frank enough to admit it. I've seen it like within our own team. It's been very taxing on people. In some ways, we all thought that it was going to be very liberating not to have to go to office, not to commute. And that part has been okay. But then it took a big toll, like on our family, like on my kids, like not being at school with their friends, took a big toll on them. You know, like we hired people, we made investments. Some of them I never met in person. And it was amazing, like to go for the first walk, socially distanced walk with masks with them. Like, it's been game changing. I think as people, like we just crave that bond. So I really hope that, you know, we can fix the COVID issues, get vaccinated, do whatever we can, still hold up good practices. But I hope we can get that human touch, that human element of what we do back in some way or shape or form.
Wow, great thought process there. And I know that a lot of our audience has the challenge of figuring out how to solve that problem. I guess there's likely an impact on Silicon Valley. You think that maybe this is a further erosion of Silicon Valley as the center of the tech universe, that people can operate more with Zoom and that it's so expensive to live there now, or you think that's still a long time coming?
You know, I mean, look, here's the thing. We have a very diverse team. I'm not a Silicon Valley Nate. I mean, I'm a transplant in Silicon Valley. Now, I have been here 25 years. I'll tell you that there are a lot of great things about this place, and there's probably a lot of things that are really, really hard. What I want more than anything else is that the thing that I'm most proud of that makes me happy is to find founders and companies when they're underdogs, right? I mean, some of our recent investments like Stream is in Boulder, in Amsterdam. We made another investment in Austin. You know, we're looking at other companies. There's like one that we're looking at, you know, that's in Berlin. And then some that are in Silicon Valley. Like, I love it when people succeed that are not in an obvious location in the world. Because there is nothing that sends a message saying you underestimated us, you didn't think we could do it, but we did it. And I love that story. I want to be part of it over and over again. And so I think we deserve to see success in other locations around the world. But then I would also be lying to you if I said Silicon Valley has no advantage. I mean, there is an advantage here. There is extreme concentration of capital, talent, management depth. So there's a lot of good things, but it comes at a very high cost. And people like are always looking for the next big thing. So again, just like everything else, it's a balance, right? I mean, it's funny, like all of our companies that are not in Bay Area have the least amount of recruiting issues, but then they have the highest amount of, hey, we're trying to look for a senior level manager or somebody with experience is tougher. And then none of my companies in the Bay Area ever worry about getting somebody with the right experience or depth, but they have the highest rate of employee churn, employee issues, people jumping up companies, like there's constantly issues with comp and other stuff. So, I mean, look, somebody always like said something great. It's not that the grass is greener, is that the brown spots are in different locations, right? Like it's easy to look at your neighbor's lawn and say, oh my God, it's so beautifully green. You just don't know where the brown spots are. So there is good and bad on both sides.
I've been integrating in some of my comments and questions that people are bringing in through the chat, and I encourage people. I
hope we're covering them,
doing
and I'm happy to cover them more with your help.
Well, I am, and one of the questions that came in is, do you think this is a founders or an investors market, or maybe there's never such thing as a founders market? Do you think there's so much money on the sidelines that the founders are able to, and valuations are high and the market is flying, that this is a great time for founders, or do the VCs still have the upper hand?
Look, I think the answer is a little bit more complex, but let me touch on it in two different ways. Overall, everything else being equal, I think given the amount of money, I would say the advantages with the founders, and it has been so, and shifting to the founders, at least in the last 10 years. I think that is a trend. It's a cyclical trend. I think it's a pure trend. I don't think that trend has changed. Having said that, and having backed a wide range of companies, sometimes I don't know, it's really hard for me to see the difference between haves and have-nots. Even with our track record, even with our best hopes, sometimes we back companies, and if they're in a unique niche area, there is such a difference between being in a hot area. Like if you're a company and you're building something in infrastructure, in cloud, developer ops, security ops, or security, it's such a hot market right now. And there are a couple others, I don't want to use the term unlimited money, but there is very strong demand. And then there are other areas it's somewhere in health and somewhere in a niche area of health, and you're solving an issue that might have a little bit more complexity. All of a sudden you go from having access of almost unlimited investor interest to having access to only a small group of niche investors. And then it's kind of crazy how different the picture is. And that's one of the reasons why we like to do things in a broad way. Some of these companies are more difficult to get started and scaling. It's much more difficult to find follow-on investors and getting investor interest in them, but we still feel strongly that they should be backed. And then some of our other companies are literally getting term sheet after term sheet. So all I want to say is, just because they're an overall trend that is founder friendly doesn't mean that it's equally shared across all founders. The area that you operate, the area that your company plays a big role in how much demand that you have. And I think the second most important thing, honestly, is if you ask me, founders' ability, founders' narrative is so important, right? You can take the exact same company, take a founder that's extremely charismatic, is very well able to articulate what the company is all about. I think pretty much unlimited money is going to follow them. And sometimes this is really, I know it sounds really unfair, but founders that, are maybe not the most charismatic and are not able to very clearly articulate what makes them and their company special will probably face a harder time. So if you ask me, the ability to narrate your company is so important, to sell customers, to hire employees, to get investors. I wish that's what they taught me at school, that I had to learn the hard way well over 10 years. Probably the most important skill you can have as a leader and CEO.
Especially with the importance that you place on choosing founders. Do you think that these technology engineering founders should go to Dale Carnegie before they pitch you?
You know what? I think they should do everything they can. So let me give you an insight. Look, I'm not the world's funniest person, and I'm definitely not the world's most articulate person. Everything that I do sounds like kitchen sink. And I think when I was first fundraising for my fund and I wanted to go through the experience to see what our founders feel like, I must have had something like 60 or 70 no's. And I think I was on the 109th version of my deck. So if anybody tells you that there is a silver bullet, there isn't. You know what it is? Repetition, repetition, repetition. And you just take the no with a good heart and just try to make it a little bit better. And like, try to understand what went sideways and wrong. Just make it a little bit better, a little bit better. And then it's going to be like very hard. Like I used to have fear, of being in front of people. I just said, you know what, I'm going to face my fear straight on and, like be in front of people constantly. Like I used to like shake a little bit. Like I used to be so nervous, feel like my heart is coming out. Like first 20 times, maybe I was just shaking. Next 50 times, things got better. After 100 times, I'm like, I've done it 100 times. I know it's uncomfortable. I know the drill. I can roll with it. That's the thing, like that. Hey, like you can keep improving. Like, don't just like get disheartened by the one episode, whatever. And I wish and sometimes these courses really help, right? But you got to be able to like either through courses or coaching or whatever, or just watch like podcasts or YouTube videos of people that are really good at it. Try to like take great like tidbits from it. But it's really important to keep working on it. I think it's something that every leader needs to get great at, whether they have the raw material or not. Have hope that even people with not the right raw material can still get there with just diligence and hustle.
And great communication skills, sounds like. So why the 4-leaf clover over your shoulder?
First of all, we basically thought 4-leaf clover, it's lucky, orange is a happy color. But more importantly, Felicis means good fortune in Latin. And we really believe in engineering the good fortune, engineering serendipity. And that's where our little 4-leaf clover comes from, that yes, obviously we do hope to be lucky, but we also hope to engineer that luck and engineer that serendipity, both for ourselves as well as for our founders.
Fantastic. The ability to engineer all the luck into your portfolio. That would explain why you're one of the few that had 3 public offering exits in the last year, correct?
We try our best. It's ongoing. We're working on the next ones, and I appreciate everybody's time. I hope we were able to address your questions. Thank you for fantastic moderation, Michael, and thank you for the opportunity, David. I hope this was interesting and insightful for everyone that had a chance to join us today.
Yeah, I think it was great, and thanks a lot for spending time with our audience. And David, thank you for putting this all together. It's great. I know our clients every day are asking for this type of input. So thank you very much, both of you, and thanks for everybody.
I'm just so grateful to both of you. This was great, and I want to thank again our secrets. I love the the 4-leaf clover. I'm a Murphy, so I got some Irish. Thank you. Sometimes make your own luck, and sometimes have others make it for you. Michael and the firm, those Brisbois, just want to thank you for making our luck here, making this event possible. Always fun to do events, period. But when you have an amazing speaker, Aydin makes it, time goes so fast. I'm so sorry we're out of time, everyone. I had some great questions from the audience. And of course, Michael, thank you. You did a great job as always. Look forward to the next one. And look forward to all gathering together in person someday soon too. But it's tough. Been a tough year for everyone. I just want to say saw some familiar names in the participant list. Sending best wishes to all of you, and looking forward to seeing you all together in person soon. So thank you again, and all the best.
David, thanks, Michael. Thanks everyone.
Thank you, everyone.
Really appreciate everyone's
4-leaf clovers for all.
Thank you. Appreciate it. Absolutely.
Take care.
Bye.
Bye-bye.